You. Today is Wednesday, the 8th of July 2026. My name is Francisco Gaffney, and this is my daily streaming all about governance, risk, compliance, and advisory boards. Yesterday, we talked about scale, brands, people, and partnerships. And today, we move into the right side of the model of the advisory board operating system. We are going to talk about this milestone that is very important, which is growth and capital, or predictability. So that implies partnerships, your revenues, and your assets. And this is where a lot of growing business get caught. A business can grow and still become less reliable. So they have more sales, more activity, more proposals, more projects, and more people, but less trust in the numbers, less confidence in the forecast, less certainty about the cash or the cash flow. That is why predictability matters. So let's take a look at the model, how it works. Specifically, we are going to focus in this portion, which is predictability, partnerships, revenue, and assets. Now, predictability growth is not about sounding confident. It's about being able to explain what will happen next and why. So let's take a look at three problems with this. Problem number one is that leaders clap for revenue but do not test the engine underneath. Revenue looks good, but margin is soft. Customer works is hidden, discounting is normal, delivery is heavier than expected, and cash comes in late. So the top line looks strong, while the business underneath is sweating very hard because actually it's very, very difficult to manage. Problem number two is that capital without confidence. Money may be available, that's true, but the business cannot always explain where it should go. Some assets deserve more funding, some need fixing, some should be stopped. But unless the board sees the difference, capital drifts. So problem number three is it sits inside the forecast. A forecast can look neat and still be weak. It may rely on best case sales assumptions, delayed cost pains, or work that takes longer to convert into cash than people want to admit. So, in other words, imagine unpredictable growth as a building taller um, on building a taller building on a wet ground. From the street, it looks bigger, good, strong. Under pressure, it start to crack and start to show everywhere the failures. Right. So, as a board advisor, what I would propose to consider is the following. First, separate revenue size from revenue quality. And this is a few valuable or useful questions to work with. So, where does the revenue come from? How often does it repeat? How concentrated is it? How quickly does it turn into cash? And how much discounting is hidden inside it? You might have a lot of very good invoicing going out, but at a deep discount. So, is that really worth the effort? And how much custom work does it create? Meaning that actually you have to do a personalized work or services or products for something that actually should be a standard procedure. So a bigger top line is not a win for every dollar all the time, particularly if it's hard to collect or expensive to keep, because then when you collect and you have to personalize and customize everything for that sale, it starts to get very hard to do. So the predictability there is pretty much vanished. The second problem or suggestion is makes assets answers for themselves. What I mean with this is assets are not only buildings, machines, software, intellectual property. They include customer relationships, data, channels, methods, technology, and working capital. So the board should ask questions like which assets are making revenue more predictable and which ones are soaking up the cash while pretending to be strategic, right? And I have this story from that I always mention, which is very hard to accept sometimes in your own organization, just to consider it. Steve Jobs, when came back to Apple in the 90s, discontinued 83% of the production line. And that was a very hard decision, but if you look Apple up today, probably was a very good decision at the time. So If nobody can answer this question, the business is not steering capital, it's drifting through it. So meaning that actually it's going everywhere, but actually not going anywhere specifically to produce a predictable revenue and profits. And the third suggestion is run the forecast as a leadership tool, not as a financial ritual. So many times you go to a forecast call or forecast reviews, and pretty much it's just an exercise of, okay, this is what we have to do, this is what we plan to do. Hey, well done, keep going. And but this is like a tool for you. This is something that is very valuable, not just how it's going to translate into revenue and the recognition on the profit recognition. Do not stare at one number and hope. Ask what sleeps first if demand weakens, for example, or ask what happens to cash if conversion slows. Ask which customers, regions, products, or services create the largest forecast errors, right? And you have this information ready because actually you start to identify patterns from prior close, prior months or prior quarters or prior years. And then you start to understand where the things are going because patterns are indicating of the direction of the business, right? It's not just the exercise. If you do a business review, do it monthly, but on quarterly basis, we mentioned this in prior live streams. If you want to do a really good understanding of predictability of the future, do quarterly pattern reviews and ask which assumptions will break the plan. Now, predictability improves when the board tests the story before the market does, right? So you don't want to go and receive a board pack or a business meeting with your team and then realize that the market already dictated what's going on. So this is exactly where an advisory board adds value. It brings outside judgment into the gaps between sales confidence, finance reporting, and operation realities. So questions that you might think or observations that you would get, for example, sounds like revenue is growing, but the quality is not clear enough, or like the forecast is neat, but not tested enough. Or like the capital is being spent, but not always allocated to the projects, or which projects is allocated. So those are useful challenges, are not to challenge the people, is to challenge the business rationale behind it, right? So what do you gain working with me? Three things: business outcomes, differentiators, and risk reductions. In terms of the outcomes, is growth that becomes easier to trust. The board sees revenue, quality, cash timing, asset strength, and forecast risk earlier. Well, as much as you can anticipate, you can respond to things rather to react to things. So the differentiator is rotating international advisory board built around the predictability milestone. That may include capital, pricing, commercial initiatives, finances, portfolio and operation capability, faster than hiring one executive. Sometimes companies spend too much time trying to hire the perfect executive to address all these things. But sometimes what you need is a 3 or 4 people that contribute to all these things from different point of view and build a better and stronger challenge to the organization, challenging in terms of actually how we're going to fix this, than one only person, which is very hard. They exist, but it's very hard to catch them or hire them, and very expensive. And also, you can go to an external consulting firm, but an international advisory board gets a lower overhead than a big consulting firm and no talent locked in. So you reduce the risk of have this kind of group thinking. But the biggest risk reduction is a false confidence. So predictability problems usually sit across functions. Sales is one part, finance is another part, operations is the strain very late in the game when sales and finance has already made their portion. So, and we spoke about these 4 different clocks that actually in the organization where you have everybody seeing their own time, nobody is coordinating the times of those clocks, so everybody works in sync. So the advisory boards helps connect the picture before small errors become big surprises. Now, as usual, I have a little exercise that we can do in 30 minutes or less, and is the following. Here I put a visual aid for us, and I'm going to put this in LinkedIn so you can take it there. Take one revenue line or business unit and put five numbers on one page. So right on the left, put the repeat revenue share, the gross margin, the cash conversion timing, the customer concentration, and the forecast variance over the last 2 quarters. If those five numbers are hard to collect, that tells you enough information that you have a predictability issue. So let's pause here for today and reconvene tomorrow, because tomorrow we're going to move and to the bottom of the advisory board operation model, which is the system, the controls, your resilience. Because once the business starts trusting the numbers, the next question is whether it can still operate under pressure. So usually when businesses are under pressure, you start to realize that the workflows are not working, the operation procedures are not documented, information sheet or activities or the know-how sits in certain people and is not documented anywhere. Anyway, so it's a full conversation, and we're going to address it tomorrow. So if you're a founder, a chair, non-executive director, or executive team, and you want an international advisory board built around specifically a predictability milestone, let's have a 30-minute chat to understand where you're coming from, where you are, where you're looking to go, so we can design an advisory board to your purpose that brings 24% revenue increase and 18% more productivity, with a faster implementation than hiring one executive, a lower overhead at a big consulting firm, no talent locked in, and swappable members every 6 months. Have a great day, and I'll talk to you tomorrow.